This is Barry Knapp with Ironsides Macroeconomics. It's Sunday evening, March 2nd at about 4:15 p.m. Mountain Time. Sky did look like that all weekend. We had friends out visiting and they got sunny skies. It's going to start snowing again tomorrow while we're on our way to New York for the week. As I mentioned a couple times in my notes, we'll be in New York City Tuesday, Wednesday, and Thursday, and have a little bit of availability on Wednesday for anyone that is in New York and would like to discuss the markets, policy, so on and so forth. So our note this week was titled Anatomy of a Treasury Rally. That was a part of the discussion and how we ended the note, though what the note really was about was building on the soft patch, growth scare driven rally in the Treasury market, sell off and corresponding sell off in the equity market. The idea we introduced the week before that um, a combination of policy sequencing, the time it's going to take to get the big, beautiful reconciliation bill done and provide that certainty for investment, but more so just the lead lags associated with restructuring an economy that was quite dependent on government spending and what Treasury Secretary Yellen called modern supply side economics, we call industrial policy, to a different approach. There is some elements of industrial policy when you think about the trade policy that the Trump administration is pursuing, but really broad-based tax incentives for the private sector to decide what to invest in. And spending cuts are coming somewhat immediately. We saw that Anna Wong, Bloomberg's very intuitive economist, is expecting a weak employment report due to government spending already this month. And that seems very plausible to us. So those government spending cuts will start to kick in right away. But it'll take time for capital spending to respond to the bounce in business confidence. And that business confidence bounce took a little bit of a hit in February, which was one of the topics that we discussed in the note. So the note really begins with a discussion of the first revision to fourth quarter GDP that showed even weaker capital spending than we had originally seen in the advanced estimate. So effectively, you had government spending adding 0.5% to GDP and capital spending subtracting 0.5% from GDP. We have to flip that. And if you think about the timing of it, if government spending goes to zero or negative numbers and capital spending either continues to subtract or doesn't rebound right away, it would be very easy to get to 1% growth in the first half of the year. And that's what we think the market is starting to respond to. Remember, it was only a couple of weeks ago before this growth scare started that we were on with our buddy Kelly Evans on CNBC defending our view that we still think we're getting 100 basis points of rate cuts this year. The market's come a long way towards our point of view now. We have something like 69 basis points of rate cuts priced in. The 2-year Treasury is back below 4%, and we think that the Fed will be probably cutting again by May, just because of how the economy is likely to progress, given just how weak capital spending was. And again, in the note, we really started to dig in on intellectual property products, software, R&D investment. These are components of CapEx that was impaired by tax, modern supply side policy. The Biden administration and 117th Congress allowed some of the broad-based tax expenditures, tax incentives, components of the Tax Cuts and Jobs Act to expire. And those categories have been in downtrends for over 2 years now. And we are quite worried about that. Now, additionally, NVIDIA's results failed to really stabilize concerns about tax or tech investment as well. So we've got a very weak capital spending environment. In our note the previous week, we showed just how soft net revisions for the technology sector actually is. And people have this idea that we're having this Gen AI investment boom. And for the scalers, that's certainly true. But software investments coming down, R&D investments coming down, and we are struggling from an economy-wide basis with investment, and it's going to take time to recover, and it's going to take strong business confidence to recover. So then we went on to discuss those February regional Fed manufacturing and service sector surveys that showed a big setback in capital spending plans in February, likely due to trade policy uncertainty. Hours worked were down. Recall in the January employment report, we had a very weak hours worked number. Now that looked like it was a function of weather, but in the Fed surveys, it kept going down in February. So it's probably something more than just weather. And we've been maintaining all along, as our regular readers know, that we have an unstable full employment labor market. We have very weak churn and turnover, which, by the way, the JOLTS report is not coming out on Tuesday before the payroll report, as it typically does. So we're not going to release a preview note, because that's the big part of what we generally try and write about, is just what do those flows look like through the labor market. We'll have a lot to say about the labor market in next week's note after we get payrolls. But demand, we think, is also weak, and we've noted that the Atlanta Fed Wage Tracker series has a negative wage differential, meaning wages are growing more slowly for the lowest quartile. A very rare occurrence. It happened in the aftermath of the global financial crisis for a couple of years, but typically in the history of that series, going back to 97, that's not been the case. And we have very weak churn, as evidenced by wages for job switchers growing more slowly than wages for job stayers. Again, very rare. We've never actually had both of those things occur at the same time, even in the global financial crisis. So for us, the labor market looks, Austin Goolsbee described it as stable full employment, and we would describe it as unstable. Maybe full employment, maybe not, because the Conference Board survey that came out last week, labor differential, implies the unemployment rate could jump as high as 4.3%. So we don't know if we'll get that big a jump this week, but it wouldn't shock us. With respect to the employment report, we'll take the under on payrolls, we'll take the over on the unemployment rate, we'll take the under on average hourly earnings, and the work week might bounce a little bit. But as I said, in those regional Fed surveys for February, hours worked fell for both services and manufacturing. So corporate environment doesn't look great here. We talked a little bit about tariff and trade policy. We've had a real evolution of our thought process on that. We were very much, Austrian, free market. Let's try and lower tariffs around the world. We've become just as frustrated with that as the Trump administration has. 10 years, nothing is happening. The rest of the world is not going to unilaterally disarm. We're going to have to put a gun to their head to get them to start loosening barriers to trade. And those imbalances, make no mistake, those are big risks for the global economy. Having the U.S. run $1 trillion trade deficit and China run $1 trillion trade surplus, that's a problem for China. It's a problem for us. And it is going to have to get sorted out one way or another. We have no idea if President Trump will be successful or not, but certainly we weren't getting anywhere with Biden or Obama or anybody else's approach either. The problem has just been getting worse and worse since we gave China most favored nation status in 2001. We then went on to discuss this anatomy of the Treasury rally a little bit. And it's interesting how last fall, when the market sold off, it began with strong growth numbers and then became concerns about policy. Well, the policy outlook started to improve when Treasury Secretary Bessent was nominated, had his hearings, and then approved. But now it's morphed into a growth scare. So almost the antithesis of what happened last fall, and somewhat similar to what happened in 2023 when Treasury and the Fed took actions to stop the sell-off when 10s went to 5%. And then the rally became, the nature of the rally changed from policy to growth concerns through last summer. So anyway, that's really what's going on. We thought we could get 10s to 420. We got there in a week. We'd have to say 10s now look like they're going to at least 4%, maybe below, maybe even testing that 380 low last summer or last September actually. And the stock market, this is not worth 4 or 5% on the stock market. It's probably worth 10. So we'd be cautious about putting any new money to work right now. And if you're nimble, buy some puts. We suggested put spreads like 5% out of buy the 5% out of the money put, sell the 15 to 20% out of the money 3-month put. Probably a pretty good trade right here because we do not think the market will completely collapse, but a 10%er would be about what we think what's likely to happen to the growth outlook, nominal GDP over the next several months, first half of the year is likely worth. So that's it for me this week. Again, I'll be in New York. The CNBC appearance, got a Fox business appearance. Should be a fun time. Good meetings with clients. Got a conference that Stephanie Link of CNBC fame is hosting for all her advisors at Hightower. We'll be on a panel, and we're looking forward to that too. So have a good week, everyone. Barry Neff from Ironsides. Thank you. See you later.